Yeah, thanks, Sarah. And I'm excited to be here again. This is probably my favorite conference that I do each year now. And I feel like a charter member since I was here last year as well. Yeah, I'm going to be presenting public dissentiment, and this is the practice-based part of my PhD dissertation. Finishing that up at SUNY Buffalo right now. And so what I'm researching actually is human agency within automated decision-making systems. Yeah, if I haven't given you a sticker yet, I'd love to meet with you afterwards and give you a sticker for the project. So public dissentiment is an online application that helps protesters negatively impact the price of a publicly traded stock by using the same sentiment analysis tools used by stock trading algorithms to generate social media posts and to link to news stories that will have a strong negative sentiment when algorithmic trading bots machine read them. If this is done in a large swarm or with very influential people, it should result in a flash crash in the targeted company's stock. A flash crash is when there's a sudden drop, when liquidity just drops from a certain market. So you see a complete drop in the price of the stock, and then there's usually a quick recovery. Long-term investors like in pension funds or mutual funds aren't affected by flash crashes because they're not going to sell their stock within a few seconds. But the boards of these companies that are targeted, they'll notice because it makes their stock seem more volatile. So it's a way for protesters to communicate their dissent with these companies. From an investor standpoint, when people are protesting your company, it doesn't usually matter. Say they're upset with your labor practices or something. It typically doesn't matter to investors that people are upset about that. So what this does is it helps you create social media posts that they will care about. And you'll see that some of the things that are generated, it makes sense when you see it as talking about things that would cause the company to lose money. So the developments in two technologies make this the effectiveness of this app possible. The first is in networked infrastructure for trading, and this includes the physical networks and the rules for how the networks must operate. Changes made to network architecture also affect the participants' roles in the market, specifically whose responsibility it is to provide liquidity to the market. And I'll explain this as we walk through it. The second development is in sentiment analysis technology and the fact that most of what people put on the internet's now easily machine readable, so it can be quickly analyzed. So the idea for this project came out of my research into the role of hacking and hackers in the development of the network stock exchange. So the current system that we have for trading stocks evolved through a battle between the exchanges themselves and outside players trying to gain access by leveraging new technologies. Eventually, the major players in the system were either forced out or they embraced the new tactics and technology. I thought it'd be really great if we could somehow leverage the same technologies to help people protest these companies rather than just making money ourselves. So this is Thomas Petterfy. He founded and he's the CEO of Interactive Brokers. It was the first algorithmic trading company. He's also responsible for the first fully automated trade on NASDAQ, which he did by hacking NASDAQ's machine. NASDAQ would rent machines from brokerages to make it easier and faster for traders to place orders. But the machines were just to facilitate communication. The trades were supposed to be entered by people. In violation of the terms of service, Thomas Petterfy cut the cables leading to his NASDAQ machine and ran the wires through an oscilloscope and then into his computer, where the computer would calculate which trades it should make, and then back into NASDAQ's machine. He'd already been using algorithms to decide what trades he wanted to make for a while, so cutting the cables and running it into his computer was just fully automating this process. So NASDAQ noticed a huge surge in the number of trades that he was making, so they sent a representative to see what he was doing. And so he was very proud of it, and so he shows this guy that comes to him to see what's going on, like this machine he built. And the guy was like, no, I don't think you can do this. I'm not quite sure why, but I'm going to go back and ask around and figure out why you can't do this. And so he leaves, and he calls him about an hour later. And he's like, okay, yeah, we figured it out. In the terms of service, it says all orders must be read from the screen and entered through the keyboard. So you have a week to dismantle your machine, and I'm going to be back to check on it. And sure enough, he was back in a week. But in the meantime, Thomas Petterfy went to NYU and got some engineering students to rig up a Fresnel lens to the screen so that it could read OCR from the screen. And then he built a matrix of pistons over top of the keyboard so that it would just like hammer in the orders when they would come through. And so when the NASDAQ representative came back, he was expecting the order levels didn't go down. And so he was expecting to hear a lot of ruckus. He must have hired a lot of traders to start entering in these orders for him, and it was real quiet. And all of a sudden, it sounds like a machine gun. And he didn't quite know what to do about that because he was technically within the terms of service at that point. So they just let him do it. So the most significant change as far as this project is concerned is in market making. So this graphic here shows how market making works. The ask price is how much a market maker will charge you to buy a security, and the bid price is how much they will pay you if you want to sell it to them. So the difference between the two is called the spread, and this is how they make their money. You could think of this as like when there used to be stores that would buy used CDs. They were never going to give you what they were charging to sell the CDs that you would buy there. So not so long ago, stock exchanges operated through a system of designated market makers. This is either a person or a corporation who agrees to always buy or sell a security no matter what the market conditions are. So there'd be market makers for Apple stock and market makers for McDonald's and so on. And this would guarantee that those stocks always have liquidity. Because if there's no liquidity, this means no one's willing to buy a stock, and it goes into free fall until it gets to a point where somebody actually decides they want to buy it. So the market makers for high volume stocks are now all high frequency trading bots, and they're not required to trade when market conditions are unfavorable. But so even though market makers were required to always buy and sell stocks, they didn't always do that. And during the Black Monday crash of 1987, market makers at NASDAQ they stopped answering their phones when the market went into free fall. And this caused some investors to lose everything because they couldn't get out of their positions as the market's falling. 2 years earlier, in 1985, NASDAQ created a computerized trading system they called SOAS, which is short for Small Order Execution System. And SOAS could execute small trades over a modem connection. And this is sort of like to handle nuisance trades, because they wanted to deal with like all the big, the high volume trades. So they could use SOAS to deal with all the small trades that they didn't want to handle. So market makers, they had the option of using SOAS, but they weren't required to until after the outrage from this 1987 crash. NASDAQ made it mandatory, sort of to appease the people using NASDAQ. So one of these investors who lost everything, his name is Harvey Hoeken, and he was furious with NASDAQ, and he had written his master's thesis on the market structure. So he realized that SOAS could be used for arbitrage by buying from one market maker and selling to another when prices moved quickly. So Harvey Hoeken started to write these how-to guidebooks for how to do this type of arbitrage. This is the cover of one of them here. And the market makers who were losing money to these people through the SOAS system, they started to call them SOAS bandits, sort of a pejorative term for them. they weren't really robbing them. What they were doing was totally legitimate as far as the system's concerned. So soon, computer programs were created to help SOAS bandits, and this is one of them here. This computer program is called the Watcher, and it was programmed by Josh Levine. So what you're looking at is what a SOAS bandit would see when they're trading, and you can see the price quotes from a stock's bid and offer from different market makers. And so in theory, all market makers should raise and lower their prices at the same time, but sometimes market makers, they just weren't paying attention, they're sleeping on the job, and the prices would be out of alignment for a few minutes. So a SOAS bandit would buy a stock from one market maker and then sell it to another one as soon as the first transaction cleared. This is usually within 10 to 15 minutes. But there's also transaction costs involved. So you couldn't do this when there was just a small difference. It had to be significant enough that you would actually make money. And you could very easily lose a lot of money trying to do this as well. So they started to add features to this program to help automate this type of arbitrage. One of them is called the monster key. And what this would do is if you hit the key, it would automatically buy either 500 or 1,000 shares of the stock that you're trying to sell without you having to punch in the numbers into the keyboard. It saves you some time. But this ended up making arbitrage a little bit like a video game. And so you're watching the screen waiting for something to move, and then you quick hit a couple of keys and make some money. And supposedly the brokerages that SOAS bandits were trading in resembled video game arcades. And the people that did it, they were usually younger guys who they'd go to work in T-shirts and shorts rather than wearing suits. But this new style of trading where you only hold a stock for a few minutes before you sell it is what led to high-frequency trading. And programs like the Watcher laid the groundwork for completely automating the process. The programmer that made the Watcher, he also made an ECN, or Electronic Communications Network, for trading stocks outside of a stock exchange. So you may have heard of pools of liquidity, like dark pools or lit pools. These are just ECNs. And this picture here this is of Island's headquarters. It was at 50 Broad Street, which is just around the corner from the stock exchange. I really like this because the sign on the front is actually a styrofoam that they painted to look like it's actually carved into stone. So they kind of remind me of tactical media artists. But Island, they ended up forcing structural market changes onto the system itself. And this laid the foundation for high-frequency stock trading. And here's a list of some of the structural changes they were able to impose. A lot of these things were things that the SEC had already wanted to do, but they were getting a lot of resistance from the exchanges themselves, like NASDAQ and the New York Stock Exchange. They're saying, you can't do this, it'll never work. So when Island did it, they had an example they could point to, and if people had an alternative, they would just go with the alternative. The changes that are important for public dissentiment are allowing traders to trade directly with each other, which opens the door for high-frequency traders, and the creation of the maker-taker system, which is where the party that facilitates the trade by crossing the spread gets a small kickback for providing liquidity. And this is how most, if not all, of high-frequency traders are making their money. And this is basically what it is. So if somebody has a price out there to sell the stock and you meet them at that, you get a kickback for taking their price. So Regulation National Market System, or Reg NMS, is what put a lot of these changes into law itself. So Reg NMS also codified over-the-counter market makers, meaning you didn't need to be a designated market maker to make a market. And this is what allowed high-frequency traders to become market makers. So this leads us to high-frequency trading. This is where we're at now. And it's debatable whether or not high-frequency trading is more or less fair than the previous system. They have their own tactics for manipulating the market, and they actually look a lot like DDoS attacks and IP spoofing or spamming the market with disinformation. And Reg NMS doesn't address any of these things. So by the time it was officially enacted in 2007, it was already obsolete in the terms of the technology it was trying to regulate. So high-frequency traders, they make very little money on each transaction, usually a penny or fractions of a penny on each share. So it's extraordinarily expensive to run a high-frequency trading operation. The data feeds alone usually cost more than $20,000 per month. So they can't afford to lose money in the process. And there's in 2011, Knight Capital, a high-frequency trading outfit, managed to lose $440 million in 30 minutes. So there's sort of precedent for like what can happen if you're not careful. So they're extremely risk adverse. And so they use sentiment analysis to avoid risk. If they detect any amount of uncertainty in the market, they just stop trading, and that creates a loss of liquidity, and sometimes you get a flash crash. So sentiment analysis is the other technology that sort of allows this to work. So there's two types of sentiment analysis that come together in stock trading. One comes from financial theory, and the other comes from artificial intelligence and natural language processing. And they're measuring two completely different things. Though in the algorithmic trading systems that use these, they kind of blend them together in a way that kind of makes sense if you just don't think about it too hard. In finance, sentiment's a technical term that represents an opportunity for arbitrage. It implies an irrational or unfounded belief in a price. And financial sentiment's calculated by things like high-yield bond returns and the TED spread, which is the value of a treasury bill to a euro dollar. And financial sentiment's based on the old idea that greed and fear are what drive the markets. It's sort of a holdover from classical economics and Benthamite utilitarianism. The idea that people acting in their own self-interest is what makes the economy operate, even when you're using like statistical processes. And this chart shows the pendulum of investor emotions, and CNN has their own fear and greed index as well. Classical economics is not really my area of expertise, but I'm assuming that somewhere towards the end of Wealth of Nations, there isn't something about language processing or statistical analysis. So they started using sentiment from language processing to calculate financial sentiment, and it kind of worked. And over time, it started to get better. And this could be that as they let algorithms trade, whatever it is that an algorithm thought was a good trade would be what that algorithm would buy. And the more algorithms that are doing this, the more they're in agreement. So it's like a self-fulfilling prophecy. Did I just miss this? Yeah, so sentiment analysis based on language processing, there's two types to this. One's the lexicographic approach, where a corpus of words is created and the algorithm searches for those words within a text. The other is the machine learning approach, where the corpus consists of entire texts instead of words. This could be like sentences, news articles, or even entire books. The first lexicons for sentiment analysis were made by psychologists who would give people questionnaires asking them how certain words made them feel. And these corpuses, they did work with financial news, but not great. So more recently, researchers at Notre Dame created a lexicon specific to finance, which outperforms psychology corpuses. On this slide, this is an example of that corpus there. So you can see the words that they're using. The full corpus is around 2,000 positive, 2,000 negative, and 4,000 neutral words. But you'll notice, for example, in B, there's the word backdating. So backdating is when a company's past records are changed because the actual profit they made is less than the profit they initially reported. So if you're looking to buy a stock and you see backdating in an article, this is a very bad thing. In E, you have the word easing, which usually this is a good thing. It means to make something painful less severe. If you see easing in a financial context, it means that there's a problem they're trying to get out of. So machine learning works by making a model from a corpus of text and then comparing that model to the new text and see how closely they resemble each other. So here's sort of a diagram for how it works. So you have a corpus of text, say it's news stories about financial reports or companies. You would label them as either positive or negative or perhaps neutral. And then vectors are extracted from those texts. And these would be either individual words or groups of words that appear together commonly. And you would weight these vectors depending on how often they tend to appear in positive text and how often they appear in negative text. And then you put them through the machine learning algorithm, which is some sort of statistical analysis. You could use naive Bayes or support vectors, or there's different models that people use. Sometimes they use a combination. And when this approach is done well, it does outperform a lexicon-based approach, but you need a very good corpus of labeled text to start with. And in the case where this has outperformed other models, they've hired stock traders who are very good at their job to read and label these texts. I don't have access to excellent stock traders, so the corpus or the public dissentiment's using a lexicon-based approach, but it shouldn't make a difference as far as the project's concerned, because I'm not looking for like nuanced differences, like what's a good time to buy Apple stock. I'm just looking for stories that are really terrible. So sentiment analysis engines they're ubiquitous in stock trading instruments. There's literally hundreds of them. Major companies like the Dow Jones have them. A lot of them promise things like help harness the power of social media, and they even make them for mobile devices. This is Market Parse. And if you happen to get any explanation for how the specific sentiment analysis engine works, it usually looks something like this. The bird goes into the can, then the bird goes through the wall, then you get a stock tip. So the sentiment analysis engine that I built for public dissentiment, I actually first built it for another project of mine called Emotional Stress Test. And when I would use that project, when I'd turn it on, sometimes I would get these notifications from Market Parse letting me know that my tweet about Goldman Sachs had a sentiment of -5. So this works. And if you use public dissentiment, you might get these sorts of notifications as well. And people would be getting stock tips based on your social media posts. So this is the Bloomberg terminal. This is the industry standard for stock trading interfaces. And the Bloomberg terminal and other interfaces like this, they all include their own sentiment analysis tools. And they also have like open APIs, so you can build your own and add them to it. And this has had a huge impact on the type of information that's used to find market sentiment now. On April 4th, 2013, the Bloomberg terminal integrated real-time Twitter feeds directly into its workflow platform. And exactly 19 days later, the Twitter account for the Associated Press was hacked, and a fake tweet caused a huge flash crash across multiple markets. The S&P 500 lost $121 billion, $121 billion with a B dollars within 3 minutes. And you can see in the chart behind the Twitter bird is the chart for that. You can see it just drop. And then below that's the actual tweet. What's interesting is that real people trading instantly knew this was fake because the Associated Press never says Barack Obama. They always refer to him as President Obama. And this would be, if you're making a sentiment analysis engine, this would be a very trivial thing to check for. But they don't do this because high-frequency traders are looking to be faster than everything else. And if they start checking everything to make sure it's real, then they're not going to get to the trade first. So they're just looking for something that could be bad, and that's it. They pull out. Also, the trading algorithms that aren't high-frequency trading algorithms, it would take them a few seconds to process this, maybe a minute or so, to figure out if this is bogus or not. In high-frequency trading bots, when they detect other trading bots have stopped trading, they also stop trading. Syrian hackers eventually took credit for the hack and the tweet that they put out. But this is what got me thinking that social media could be a way to intervene in the stock exchanges and give people some agency again. So this is the homepage to the app. It's online now, and it can be used. And so on the back end of this is a database that I filled, and I'm still filling with stories that have a strong negative sentiment. So a side note here, so I have the terminal outputting the negative words it finds when it collects these stories, just so I can make sure it's still working. Investment banks have by far the worst words. You'll see things like murder or murder, racketeering, drug cartel. It's unbelievable. AT&T, it's nothing like that. Why don't I just... So you find a story and then you post it to the app, but why don't I just walk you through it in a second. First, the limitations of this. I don't think this will... there's this point of diminishing return also, so that the size of the company that you're protesting, if you're protesting a company that has a lot of chatter about it already and they have a really high market cap, you're going to need a lot of people to actually move the stock price. So like a company like Apple or Facebook, you're probably not going to get enough people to actually affect that. This could work with companies that are big, but there's not a lot is said about them, so there's not a lot of information on a daily basis, like say Raytheon or a company like that. Also, higher profile people will have a bigger impact. So if you get celebrities to do this, their social media posts are ranked a little bit higher. And if you can retweet people's posts, so you have like one post that's just being passed around, that pushes it up a little bit. So yeah, why don't I just show you how to do it? You can, if you want to, you can do this with me. This is the website, publicdissentiment.org. And yeah. This is the home page, obviously. So you just hit start protesting, and you enter in a company that you want to protest. Let's just do HSBC because they have a lot of terrible news about them. And this is what you get. So you get these results that come back, and so you see the name of the story. And the sentiment that it has and the date that it was posted, and you can sort these. So they actually have one that's -90, which is really, really low. Some of the dates are, this actually has all date. You'll see some of these stories have no date, and those can be good as well. Sometimes when stories don't have a date, Google's search algorithms will add them to their daily news feed as if they just happened. There's a story where United Airlines it went bankrupt in 2002 or something, and in 2006, somebody was searching it late at night, and this pushed it towards the top of Google's ranking system, and it got put into the news feed, and when the markets opened the next morning, United Airlines stock dropped by 70%. So I'll just pick this story. So it gives you a summary of the story as well, so you get to see what it's about. Double check, make sure it's not a mistake or actually about something else. Like sometimes with companies like Johnson & Johnson, you get a story about Magic Johnson that happened to be bad. And you create a post. And so you can do this on either Twitter, Facebook, or Google+. So you choose your social media outlet that you want to use. And you get these suggested tweets that you can use or posts for Facebook or Google+. And you can pick one, or you can change it. These words here are the negative words that were found in the news story. So if you use those, your social media posts will also have a stronger negative sentiment. And then you can tweet it directly from this interface. There it is. So yeah, is there any questions or comments? Or?
I can take, cool.
Have you, whoa, hey, hot mic. Have you been able to do any tests that, organize some actual folks to run tests that you could see an appreciable change on an item on the stock exchange?
I haven't yet. This is actually this is the public debut. So, but yeah, I need to do that.
I was going to ask, what's to stop companies from doing this to each other? Is there any regulation about this at all, or would be just internal company policies?
So that's a good question. I should mention, if you trade on, so if you do this with the intent on lowering a company's stock so you can buy it lower, you can go to jail for that. So it's illegal when companies do it, but they're undoubtedly doing it, right? I mean, if I can figure this out, high frequency trading outfits they're doing this and more, right?
And my second question is, what's responsible for the immediate correction? It's like non-algorithmic traders coming and saying, hey, this is at a really low price, I'm going to buy it?
Right, yeah,
Okay.
yeah. Human traders standing by, or it could be algorithmic trading bots they're not high frequency trading bots,
Right.
but they're doing better sentiment analysis. And a lot of these are they work as warning systems where if something like this happens, it's it alerts a person to go check it out and see if maybe they should start buying stock again.
Okay, thank you.
Okay.
Just as a suggestion, you should have branded pages for current protests that are going on, like the water thing.
Oh, yeah.
And so you already have because you have a lot of pre-selected stuff, so you could be pre-selected even on the specific companies that affect this.
Yeah, actually, I have so if you search for something that's not in there, let's see, Piggy Company. If it doesn't find anything, it gives you the option to add the ticker. So you would say, I want to protest this company, and then it'll get added to the database. As long as it's publicly traded, it gets added. So one that was already requested is the company that's trying to put the pipeline in. Yeah, somebody requested that.
But if you can make branded pages that it already pre-selects the companies that you know they are affecting it,
To show them,
it's
to show
just
people.
one more step.
I thought of that. I'm not sure that I want to encourage people to just go protest things if they don't have a reason to do it. But yeah, I haven't decided on that yet.
Cool. Any other questions? Okay. In the back.
Is there a way to embed this into like a sort of a share that could go through public dissentiment if you were like a labor organization and you wanted to kind of scoop people quickly into the site to do that?
No, there isn't. But that could be a good feature to add.
Thanks.
Any other questions? Okay.
Do you know if positive sentiment also causes stock prices to go up?
It does, yeah. It won't. It's not as dramatic because the high frequency trading bots they're not looking for positive sentiment. As long as there's somebody willing to trade against, they're going to jump in. But yeah, if positive sentiment will cause it to rise a little slower.
Anyone else? Okay.
I'm just playing around with it, sitting here. Maybe you said this and I missed it, but why are why do the companies' names come up with this symbol in front of it? Is that like to the bots especially, like the dollar sign in front of the?
Right. This is something that happened a few years ago. If you put a dollar sign in a company stock's ticker symbol, this is to let traders know that you're giving information about a company's stock. It started with there's a separate platform like Twitter for stock trading that used this, and then Twitter just incorporated it into their own interface. So if you ever want to tweet about a company's stock, use dollar sign and their ticker symbol rather than a hashtag.
Okay. Thanks, Derek.